Welcome, listener, to a brand new deep dive. We're digging into the global financial markets this Monday, August 25th, 2025. Our mission today, to try and untangle some pretty powerful, maybe even conflicting forces shaping things for you this week. Got a lot of notes, articles here, trying to give you the shortcut.
And right off the bat, something really compelling is just how clear this dovish pivot from the U.S. Federal Reserve is. This isn't just, a hint. Chair Jerome Powell at Jackson Hole, Friday, August 22nd. He's pretty explicit. He noted downside risks to employment are rising, basically telling us, the Fed's prioritizing jobs over inflation near term. That's a big shift. Signals a September rate cut is, well, highly probable.
Wow, okay. A dovish pivot and really clearly signaled, you're saying. So what happened immediately? What tremors did that send through the markets? Okay, let's unpack this a bit. The market's reaction sounds like it was pretty immediate and forceful. Yeah, we saw this powerful risk-on rally right across different assets. The big U.S. indices, Dow, S&P 500, NASDAQ, they all surged. The Dow Jones, for example, jumped, 846 points? That's huge, 1.89%. Closed at a new record high, 45,631.74. What does a move like that really signal about how investors are feeling right now?
Oh, it signals a huge sense of relief. Optimism, too.
Yeah.
Especially about company earnings now that borrowing costs look set to fall. And look at the VIX, the SIBO Volatility Index. People call it the fear gauge. It dropped over 9% down to 15.05. That's a strong sign investors are feeling much less anxious. We also saw big names jump. Tesla up over 6%, Amazon up over 3%. Like you said, a green light for riskier assets.
So that's the push from the Fed, a strong monetary tailwind. But it seems like it's immediately hitting a significant geopolitical headwind. These extra tariffs on Indian exports, 25% kicking in August 27th, some levies going as high as 50%.
Yeah.
How much do these trade tensions sort of dampen that Fed enthusiasm?
Well, they definitely do. These tariffs, they're not just talk. They're a real threat to profits, to global supply chains. Analysts are already saying, these are likely to weigh on markets. We've got companies like Estee Lauder mentioning tariffs could cut annual earnings by roughly $100 million. So it adds this layer of real uncertainty that even a dovish Fed can't just, wipe away. Companies have to rethink things.
Right. So it feels like we're now in this slightly strange bad news is good news situation, where any sign the economy is cooling might actually be welcomed by the market because it points to that Fed action. Almost like the market's gotten addicted to the stimulus itself. What data points should we be watching this week if we're looking for clues on that narrative?
Absolutely. That's the dynamic. Any data showing a cooling economy will likely just reinforce those September rate cut bets. Today, Monday, we've got Germany's IFO Business Climate Index, plus the U.S. Chicago Fed National Activity Index and Dallas Fed Manufacturing. Later this week, the really crucial ones, U.S. GDP, that's the second estimate for Q2, and, importantly, the core PCE price index. That's the Fed's preferred inflation gauge. They'll be key economic health checks.
Okay, and looking globally, the picture seems a bit more mixed, doesn't it? U.S. and Asian markets like Hong Kong's Hang Seng jumping 2%, they seem to have embraced the bullish news. But European markets like Germany's DAX trading down maybe 0.40%, they seem more cautious. Subdued. What's that divergence telling us? Different worries in different regions.
Yeah, I think it suggests European investors are maybe focusing more on the why behind the Fed's move, the underlying deteriorating global economic outlook that actually prompted the dovishness. Less on the immediate market pop. They're looking past the rate cut maybe to the global slowdown that made it necessary. That could hit Europe's export economies hard. Even U.S. equity futures are pointing a bit lower for the open today, just a natural pause maybe after Friday's big run-up.
Right, catching its breath. Now let's zoom in on specific companies, seeing some pretty dramatic pre-market action. Open Door Technologies open, surging nearly 40%. That seems like a classic play on lower interest rates, even though they're not profitable yet. But then you've got New In Commerce, Neji down about 13%. Profit-taking maybe, after that absolutely wild run-up this year, over 1,150%.
That's a fascinating contrast, isn't it? For those unprofitable beneficiaries like Opendoor, how much of that jump is real fundamental re-rating versus just pure speculation on cheaper money? That's the key question for you, the listener. And we also need to watch out for structural things like IPO lockup periods expiring, G&G Electronics and Brigade Hotel Ventures, for instance. On August 28th, that can unleash a lot of selling pressure sometimes.
So it really feels like the market's being pulled in, multiple powerful directions at once.
Yeah.
You got the euphoria from the Fed announcement on one side, and then the friction from trade wars, the underlying economic slowdown signs, and these specific company stories on the other. It's amazing how fast sentiment flips, isn't it? from caution to euphoria in just one speech, even with these risks still out there.
It really is. And what's fascinating is the interplay in the bond market. It's pricing in rate cuts very aggressively. The 10-2-year Treasury yield spread, it's widened out to positive 0.58%. That's usually seen as a reflation signal, suggests maybe fewer recession fears, maybe growth and prices picking up again. But volatility is still pretty low, and commodity prices like oil are kind of flat to lower. That hints those global growth worries haven't gone away.
So this deep dive really shows you a market trying to figure out a complex, maybe contradictory path forward. We've got that immediate Fed optimism bumping up against trade impacts and these ongoing economic checkups.
Which leads to a really important question for you listening. How do you square that? How do you reconcile the market's short-term optimism driven by the Fed with these tangible trade issues and the longer-term health of the global economy? What do you think holds more weight in the end?
We hope this dive helps you navigate these currents, gives you a fresh perspective on what's shaping your financial world this week, and maybe beyond.